Again. All right. Thanks so much for tuning in. This is our weekly Precision Markets office hours call with Precision Coach Brian. I'm not joined today with our counterpart, Nathan, but I will be taking any questions that people may have regarding anything trading related. We host these office hours every week so that you can be able to have any of your questions answered, and especially those that may require anything visual that you may need to be able to have answered. So the format that we work on is that you will go into our chat. You'll go ahead and just post your questions, and then we'll answer questions in the order that they come. I ask everybody to be respectful of people of the question they answer, and so that we don't jump in out of order. But I'll make sure kind of to guide the conversation. So everyone, if you haven't had a chance already, go ahead and ask your questions in the chat, and then we'll begin. And don't be shy, y'all. There's no such thing as a bad question. So feel free to ask any questions away. I've also enabled screen sharing. So if since there's a chart that you want to review, a pair that you want to review, you want to talk about price action, I mean, we pretty much have this as an open forum so that anything that you have that you want to ask or have questions with, we can be able to answer. All right. So the first question we have is for Haram. Do you look at H4 direction for intraday positions, like without price reacting to S&D on supply and demand on H4? Or do you mind kind of rephrasing that question? I want to make sure that I understand it correctly. It's a question that you're asking, do I look at the H4 direction to determine like the trades that I take on an intraday trade? Is that the question that you're asking? Yeah, okay. So yes, the short answer to your question is yes. It doesn't matter specifically if I'm looking at, it doesn't matter if I'm looking at specifically intraday or swinging trading or et cetera. Like the whole basis for the strategy has to have something of a higher time frame direction that helps to be able to guide in the direction that you're taking. So when it comes to, for instance, how I look at trading, it's always going to be the same. It doesn't matter if, like I said, if I swing trade or do something else. So I'm gonna pop up here into TradingView. And so you'll notice at the very top, what do I have up there? Higher time frame expectations, lower time frame executions, reactions only, no predictions. So when I come and I look, for instance, at our 4 hour, I'm looking to say, okay, where's price going? If I notice that, for instance, before we start the day, okay, price starts around somewhere around here, and I'm looking and say, okay, well, price is in an uptrend. I know to expect from a 4 hour position that price may come down, for instance, to one of these demand zones. So here's a 4 hour demand zone that price looks to be reacting off of. And if I know expectational order flow, I know that the expectation is that price is going to come from a higher high to a higher low to a higher high. And somewhere between that higher high and that higher low, expectational order flow means that price is going to make some move, maybe down here, and then go up and go past our last higher high. So even if I'm trading intraday, I still need to know where the 4 hour is going. I need to have, especially if I'm doing intraday trading, I need to know where the 4 hour direction is going so I can make a decision. So then that's when you come down here and you start looking at your 15-minute. You say, oh, price taps right into this 4 hour zone that I have right here, this blue box. And so what I can see is here is that price ended up breaking from an order flow perspective. Price ended up coming from here all the way and kind of broke something about right here. This thing is a little bit up or down. Here we go. Okay. So price ended up breaking here. So what I see now is that price ended up coming, and here was this is a real messy area. So I'm just going to take this hold from the high and low. And here comes an M15 demand zone, essentially. But I don't like how messy it is. So I'm going to see if I can go to a lower time frame to refine it. And I always go from the 15 on bottom. So this is 14-minute, don't really like it. This is 13-minute, don't really like it. This is 12-minute, maybe a little bit better. I can refine it more to, for instance, this bearish candle. And then let's see, I go to 11. Let's see if it gets any better. 11 is a little bit better. So I'm going to change this to a demand from 11 minute and such. I mean, these are not my trading hours, but I would come down to the 1 minute after this, and I'd be looking for a chalk and flip and take a trade. So it would, we just imagine that, for instance, there's a chalk and flip somewhere over here. I'm looking to take my entry like this. And there goes like a 1 to 5. So maybe, for instance, y'all could just mark up your chart and just take this on GU and just see how it plays out. But there's ultimately no volume right now, so it's going to be very hard for this trade to really kind of continue upward. But all of my decision making from an intraday perspective is influenced by what I see on the 4-hour time frame. This could go through this demand zone, and it could decide that it wants to mitigate somewhere down here at this demand zone, because this would be considered your extreme demand zone right here. So I'll put demand H4. So either price could go do something like this and more likely go up, or it can decide to go up from here. But all of my decisions from an intraday trading perspective are what I would consider like a call of bias. And I need to have a strong bias that's going to help me to weed out some positions in places I go that I might take a loss. Haroon, let me know if that answers your question, if that makes sense. Okay, you have another question. Sometimes the 4-hour trend is long, but in 15-minute only it's in a downtrend, and you search for shorts in that case. What I tend to do, and it's just specifically according to my trading style, I want to make sure to answer that, is that I always focus is that the 4-hour is my bias, and I don't take trades against that 4-hour bias. Just because statistically I found that 3/4 of my losses came from me taking trades in the opposite direction. So what I tend to think about is we do a couple of things, right? So we're going to have a couple of colors. Black is going to equal our H4, or what's going to be called our higher time frame. I use red. Red is going to equal our M15, or what I like to call our trading time frame, which I abbreviate for TTF. And then last but not least, blue is going to be equal to M1, and that's going to be what I consider our entry time frame. So when it comes to the trend, if you know the trend is doing this, then you're expecting for price to come into some demand zone, right? Because right now we have a higher high, a higher low, a higher high. Price comes down here. So this could be considered a potential higher low. And we expect price to go off and give us a BOS to make a potential higher high. So what that means is that what we expect to see is that from a trend wise, the trend on the 15-minute would do something like this. So right down here on the M15, we have a downtrend. And up here, we have a uptrend. So I don't tend to, for instance, I'm not going to try to buy here. I wouldn't even try to look for a buy, because ultimately the 4-hour is coming down to make a higher low, which explains why on M15 we'd have a downtrend. That's also the reason why I personally don't look at the trend on M15. I look at order flow. So as soon as I have something like right here where price ends up, oh, I did this thing wrong. I had the wrong button. So you have this supply zone that broke through here on M15. And then once we have this and it breaks and it taps into this demand, I'm looking for taking buys. I'm looking for taking entries to buy and go up to here. So I'm looking again at buys, and I'm taking them to look to go past at least to here. So I hope that makes sense. I'm always constantly looking at taking trades in the direction that follows my bias. So on here, we have a, see if I can get this. We have a downward bias until it reaches a potential higher low. And then here we have a upward bias. So all of my decision making is influenced by what I can find on the higher time frame, which for our cases would be H4. And then I look for all of my trades based upon setups of opportunities that follow the our trading time frame or middle time frame, some people call it, that follow the bias. Let me know in the chat if that makes sense or not. Anybody have any questions about that? I'm actually save this picture so I can share it to y'all. Okay. Let me know if that makes sense and if anybody has any questions regarding what I just drew. Any other questions anybody may have? Any charts that people want to share? Let me know. Y'all can feel free to come off and mute as well, guys, if y'all have something that y'all wanted to say also. Let's see, I just saw a message from Haroon. I think I'm not patient enough to wait for price to retrace in H4 because I only trade EU and only NY session. Well, it doesn't. I'm gonna go back to the chart real quick and show y'all. All your decisions on a daily basis should always be taken based upon some higher time frame backing. Y'all shouldn't be sitting around looking at lower time frames waiting for price to do things. So, like for instance, I'm gonna go to EU. You don't need to wait for price to come into the zones. You just need to know where it was at, right? So you start the day, and the day starts around right here, right? So before the London session even starts, I already have a bias that I know that price is going to go in a buying direction. And the reason why is because price made a higher high, and right before the day starts, it's going to be one of two things. It's going to come down to one of these areas and then go up to go break, or it's just going to continue to go up. So let me show what that means. This candle prints, and this is 0-0. You already know that your day's up. So now you have a decision of what to do for the day. Like your decision is that, oh, okay, I'm going to buy for the whole entire day. Now I'm going to go down to the 15 minute and just show y'all what the 15 looks like. So remember, this was the day start. Okay. Here's the day start. London session hasn't even started yet. So all of this was the London session. This was the Frankfurt Open at 1 o'clock my time. It is right there. So that's the Frankfurt Open. This is the London Open. So now we already have a decision that's been made for us. It's that we're looking for bias already. One, because that was part of our bias, but two, that's because we've already seen price come up here. And so now we're looking for where's the zones that price could possibly tap into. And then you go all the way to where the New York Open is. New York Open for me is right at 7 o'clock. So here's the New York Open. We don't really have a buy bias because we had price go from, let me just draw this real quick. We had price come from here to here, essentially come up to here, break through, and create a new supply. So now we're waiting for the price to break. Well, price did this. So now what do we have? We have a chart that we can be able to base upon. And so you got right here, you have this area that you can look for. You can either use this breaker box. You can use that breaker block to be a potential demand zone and say, hey, here's an M15 demand. And then as you see, we have opportunity for us to enter somewhere, probably right here. So I'm going to put a circle around it so you can show what you're looking for. All right, so this is the area that we're looking for now. We're going out to 1 minute. So 1 minute. All right, cool. So what we have here, we have kind of a range of consolidation, really, more than anything. And then price kind of comes up for this area. So there's a couple of different ways that you can kind of approach this. So price ends up coming, let's see, trying to see where we could use. Price comes down here, next supply comes up, breaks and makes another supply. And so then price kind of comes all the way up here and here would be an opportunity. So I'm gonna show you how real quick. Hold on a second. So the first place you were kind of watching for it to break would have been this last little internal supply here. So price comes here and makes this move. It comes back. It makes pretty much this move and then comes back. And then price kind of goes up from here. So where your opportunity is that you would have looked to take a trade is this would have been the first the first little zone here that you could have used for a trade. And let's say, for instance, I know a lot of people in the community like to use limits. So we're going to do a limit at 50%. So here's a limit at 50%. We're going to put our stop, and we're going to do at least a 2 pip stop. And then including spread, we're going to cover, just say 2.5. So 2.5 pips. And then boom, right here, you would have put your limit order based upon the, this would have been our chalk. And this, let me find this part right here real quick. This was the last, this low was broken. And then this high was broken by a candlestick body here. So your first chalk and flip would have been considered somewhere down here. It would have been in this range. And so then that's why I created this point that was right here. So this point right here would have been the high. This would have been your second flip zone. And so now that's why we're looking at this area for entry. And so now we have your entry that's taken. And the price would have gone on at least for a 1 to 6 R. So you would have made a good profit and it'd be a nice little trade you could have taken. From an M15 perspective, though, look, price failed to break this high. Let me get my brush. Price failed to break this high with a candlestick body. It whipped. And so now you see that price is kind of dropped in a little bit farther back into our zone. And if you go back and look into it on the 1 minute, what we would have had was essentially another chalk and flip. So I'm gonna map it out using the path tool first. I love this little tool. So price comes down here. This is our lowest wick. Price comes up here, and price comes down here with a body break. And so then this, right when it broke on these candles, this would have been where you could have looked, and this would have been our second kind of like chalk and flip. Second flip zone. So if you're looking at it, looking for the entry on your 1 minute, price comes over here. Here was our reaction point. Price comes in here. I would have taken this whole little area right here as a demand zone, but I would have used it as a range-based demand and included the candles all the way from this high all the way down to this low. So that's why I have this big region. And then once again, let's say you put a limit on and you put your limit right here, your limit order would have tagged in right here. Price would have, you got 2.5 pips top. I would cover a little bit more just for spread, and price comes on here. And you currently would have been sitting in a 1-3 trade. Now, this is outside of your kill zone hours. So this is not the time that you really should be trading. But what I'm trying to illustrate to you is the chances that you have in trading and so much stuff that can be done. Now, if you go back and look at the chart, remember, all of this came from a bias that you had from the 4 hour. We said that we're buying right here. And notice how our buy trades worked out for us, even later on in the day. So that's the whole point. If you got to look, you're not looking for a price to essentially tap 4 hour zones. You're looking to have an understanding of what the 4 hour is doing. And once you have an instruction of direction, your trades will get right. Like if you get a lot of trades wrong, probably what you're going to find out is more than half the time you were wrong on direction. So it doesn't matter how big your stop is. It doesn't matter how wide your stop is or how tight your stop is. It doesn't matter what kind of chalk and flip you get. If your direction's wrong, it's wrong. And you have a 50% chance of getting direction right. When you get into a trade, the trade's either going to go up and you're going to make money, or it's going to go down. And if you're buying, you're going to lose money. So the first thing we should always have is a great understanding of direction. The banks, the financial institutions, they're not on the 1 minute. They're not even on the 15 minute. They're looking at the weekly, the monthly, and the 4 hour. And these banks determine what levels do they want to buy and sell at. So if we want to get an eye, this is not our market. This is the bank's market. The banks control over 96 to 97% of all volume transactions in the Forex market. We only control 3%. So why would we want to side with 3%? Why don't we side with the 96%? And those people will be the ones that will carry our trades ultimately to profit, because we don't have enough money to move the market. The banks do. So we need to make sure that we're on the right side of their intentions, which we happen to use supply and demand to help us give us clues and ideas of what directions they're headed. I hope that makes sense. Let me know in the chat if that makes sense, guys. Awesome. Awesome. So that's what the most important thing we talk about is direction. Direction is so important. We get that right, and we get that idea of direction, it's going to help us be able to make sure that we have winning trades and probably avoid a lot of our losing trades. So you want to go with momentum. Momentum is everything. What other questions do y'all have? Anything else that I can answer for you? Any charts y'all want to see? Okay. The next question is, can I ask about how you enter with candlestick confirmations? Yeah, so we do have a video that's in the trading, but let me give y'all kind of a quick overview. And I will say, if you have any follow-up questions about this, just let me know. But also check out the video that we have inside of our Teachables platform. And I really break down a better job, I think, than I'll probably do right now of those trading confirmations. So let me go to a pair I was looking at today. I'll go back to you. Okay, looking at the 4 hour, let's see what it did here. So let's see. There we go. Okay. Give me 1 second, guys. Let me find a spot real quick. All right. I had one on the show today, but I can't find it. Well, let me start the audio USD. Now, we're just going to say, for instance, that we have a bias on taking the sell trade, right? So we had price come through right here, right? It broke this high, and this low was responsible for breaking that high. So if I'm looking at this area as a potential area for me to sell, right? And so we're just going to treat this like this is a supply zone for M15. So then I come down here on the 1 minute, and don't follow me on direction on this. I'm just going to illustrate an example. So here, this is what we have. All right. So this high was broken. It's very, very small, but you guys see how the candle goes up here. It dips down just a little bit and then goes up forward. That's how we're able to see that, that the high or low was broken. So that's how you kind of pay attention to it. And you got to look at it because it's very subtle things sometimes, which means that, for instance, this was a low that broke in to put in that new high. So this to me would have been a demand zone. So this would have been like a 1 minute demand. And then this to me is a 1 minute supply, because it ultimately ends up breaking the zones. All right. So what happens is we have, let me get rid of some stuff too on this chart. All right. So what ends up happening is that we had price. I'm going to use the path tool to just kind of illustrate it. So we had price come all the way up here, come down here, break and put a new high. And we had price come down here, break it with a body, and come down all the way to the low. And now we have price coming right back into our zone. So right now, price is in our 1 minute zone. So that's the key of what we're looking for. So now we're expecting price to do something like this. So when this happens and we come into our zone, when I use candlesticks, what a lot of people would do was just put in, for instance, a limit order. And so the limit order says that, hey, when price comes into the zone, you can sell, and you just cover a little bit above the high, right? Now, it would have worked in this case, but sometimes price will go through those zones because you don't have the candlestick confirmations. So I look for candlestick confirmation so that, for instance, you can make it and say, okay, when price comes into the zone, I'm going to enter whenever I see a bearish engulfing candle. And so that could be your rule. so that no matter any time you take a trade, if it comes to zone, you would enter after the bearish engulfing. Now, as you see, that also just made our stop a lot bigger. So that's also something that you can also consider is that you'd have to be able to figure out what is the balance of rules. Like some people may look for a certain candlestick reversal, like for instance, the morning star or the evening star. Some people may look at engulfing candles, and that may be what their criteria is. But what it is that whenever price comes directly into your zone, you have to have some type of criteria that's met, whether it be candlestick, it could be body, it could be one candle being bigger than the other, it could be doji, and whatever that decision is. As soon as you see that candlestick pattern or that candlestick reversal or that candlestick confirmation that you're looking for, you hit buy or sell without hesitation. And I just found that for me, for market executions, this helps me to be able to know exactly when to press the button on market executions. Because I don't do limits. Because I've seen too many times, like for instance, some zones I picked, that price would just go through it. And so I like market executions, but that's also the very first way I ever learned how to trade. So I didn't know about limits until about a year and a half after I had been trading. So I've always done market executions this way. So like for instance, it would be literally just picking, like I said, picking this candle and saying, all right, as soon as I see this this bearish engulfing candle, I'm taking a sell, I'm entering the trade. And what you would notice is that this trade would have worked out. It would have had a long stop, a super big stop. But if you go back and you zoom out and just let it hold, this trade would have gone on at least for 1 to 5, but it would have taken a lot longer. It would have taken a whole extra day because of how big the stop is. So it will, doing market executions, the downside is to it, it does affect your stop. And sometimes you don't get filled in exactly at the price that you're looking at. So there's the two things to just kind of keep in mind when it comes to taking trades on market executions. So each kind of have their pros and cons, I guess you can say, in a matter of words. In answer to the second part of your question, yes, you can use 4-hour and 2-hour zones with an M15 candle confirmation. You don't have to go down to the M1 time frame. We just do that to be able to make our stops a little bit tighter so that we can have a tighter stop loss, which helps us to increase the amount of rewards we get from our risk. So it's something that, like I said, you don't have to go to M1 always. You can use it for M15. And candlestick confirmation works. It's not specific just to one, but you definitely want to use it for your entry time frame. So Haroon, on 20th May, I was confused on direction on ENY session. Can you please do another example of how you reason that case? Let me go to, Euro. All right. So you said the 20th. Oh man, my chart's dirty. Sorry, guys. It's like I've been doing some stuff on here. All right. So let's go to the 20th May and look at what we see. All right. So somewhere over here. Sorry, my thing's not really. I don't need to click on anything. There we go. Okay. So right here we have the 20th May. And so here's something that we're looking at that point, right? So price made a higher high and lower low. And so I'm gonna do supply. It's for here. I'm gonna draw one more thing. Okay. All right. Here was the New York session around the 28th, right? So at this point, what do we know information? Well, from a market structure perspective, price made a lower low, higher high, lower low. This could start a range. We know more than one thing is that price is coming right here into this potential spot for higher high. And we got one or two things that could happen. We could either have price go directly through this and make a new higher high, or price come here and price come down. So we're prepared for kind of both scenarios. So let's look at M15 at this point. And so now we're looking at M15 on the New York session. We see that price touched here, but price also ended up making this point here, where it ended up breaking this last high from a order flow standpoint on the M15 time frame. So at this point, I'd have been looking for buys when price came all the way down into this area. Now, could be right, could be wrong. Let's see what happens. Because my intuition, based upon what I can see, is that H4 looks like it could be going up into that H4 zone, which it wants to go higher. M15 is showing that it broke with momentum. And so an expectation now, based on what I can see from the two time frames, is that we're going to be looking at something like this. So does it play out? Let's see. Nope, it doesn't. So what that case would be was that price ends up coming down a little bit lower, and price ends up, let's see what ends up happening. But ultimately, price comes back and taps into your zone. So it's hard sometimes for you to get an accurate read, and that's why you have to be prepared for two scenarios. I don't know why I didn't stop. It's so weird. So even though, for instance, we're seeing that M15 order flow showed bullish, we could have expected that price goes up. But price also was at a spot from an H4 standpoint where, remember, it already tapped in right here. So we kind of have to be prepared for both scenarios and times where we don't know, have an idea. When I don't have an idea of exactly what we're doing, I don't even trade that, or at least don't trade that pair. Because if I don't have a bias like I just showed you, it can really be confusing as to which way the price will go. And ultimately, like I said, only one or two things happens. Price is going to go up, price is going to go down. You can make money when it goes up if you're buying, but you lose money when it drops and you're buying. So you have to have a kind of understanding of bias. But when you don't, it doesn't make sense for you to get in the market. And it may be good for you to just sit out and watch it. Because ultimately, let's go back to the 4-hour time frame. What happened on the 4-hour time frame? It tapped into the market, it came down, but did it come and tap a new 4-hour zone? Not really, because this would have been the last 4-hour demand zone right here that we really could have used. Now, if I don't have a clear picture, I'll even go down the 2-hour. Even on the 2-hour, I don't know exactly what it could have gotten through and broken through. Maybe it might have used this 2-hour breaker block as a zone. So here, I could have said this was meant to be a 2-hour demand zone and use that as the catalyst for it to break up. But essentially, it wasn't really too clear. But knowing that it did tap this, for instance, this H4 zone, you could have also reasoned and said that you expected price to just come on and go straight down like this. And so if you look at it from that perspective, you wouldn't have taken the sell because it didn't align with your zone. You would have waited until, this. If your expectation was for a sell bias, price comes through and breaks here. This is the last demand zone that was pretty much broken. It's right here. And so therefore, you would look at any kind of supplies that you can find. So this would have been considered an M15 supply zone. Then you would have had this break here. This would have been another M15 supply zone. And you'd have had this break right here. So this would have been another M15 supply zone. And so you could have looked into taking a sell. Here we go. You could have looked into taking a sell right from here and taking it on down. So that makes a little bit of sense for her. Let me know in the chat if that makes sense. Let me know, Haroon, if that makes sense in the chat. Awesome. All right, guys. Thank y'all so much for the great questions. Thank y'all so much for tuning in. If you didn't get a question answered yet today, don't hesitate to jump into our question sections of the Discord, and we'll be glad to answer any questions that you may have. Also, make sure to tune in for Thursday's Q&A call with Rob. Rob will be spending an hour going over the market, answering questions that you may have. And guys, if y'all haven't, and you don't get a chance to ask your questions during the questions chat, feel free to hold on to them for the next office hours call, as well as you also can sign up for one-on-one trading with any of us. So your precision coaches, Rob, Nathan, and myself, we offer ourselves for 1 hour trading time so we can dive deeply into any topics or questions that you may have. So feel free to utilize us. But this recording will be up on Teachables within this 24 hours. It'll be on for the next 48 hours until the next Q&A call. But thank y'all so much for tuning in, and we wish y'all a great trading week ahead. And we'll chat with y'all soon. Thanks, everybody.